so needless to say, we are in the midst of multiple challenges. Energy challenge, clearly, but also climate change, nature loss, social inequality, poverty, etc. Now, addressing, for example, the biodiversity challenge is really critically and important. It's not only critically and urgent for our own health and well-being and for the planet's sake, but also for the global economy. And let me highlight a couple of institutions that make that point. For example, the WWF issued a code red alert for humanity, given that the global population of several species has declined by nearly 70% since the 1970s. Then the UN highlights how deeply intertwined the climate and the biodiversity crisis are. Essentially, in order to address the climate crisis, there's no way around it, but you need to address the biodiversity crisis. Now, what does this really mean as an investor and as a business? Well, let's break down the planet. I realize it's a very unfortunate choice of words here, but let's break it down anyway, okay? So about 30% of the planet is land, 70% is ocean. Clearly, for a country like Sweden, the oceans are very, very important, but so is land, okay? So within land, then, 70% is habitable, the rest not so much. About 50% is agriculture, nearly 40% are forests, and then within agriculture, almost 80% is taken up by livestock and 20% by plant crops. Yet, livestock only provides about 20% of the calorie and 40% of the protein supply that we need. Now, what does this mean? Well, we have a couple of choices here. Either we try, in order to ensure food security, either we try to motivate households to move from a dairy and meat-based diet towards more plant-based diet. That might be a difficult thing to do, okay? For sure, it would open up a whole new area of research. How do you incentivize households to move towards a plant-based diet? Or, and, there's no silver bullet here, but we need to think about how do we actually make our agricultural land more productive to ensure food security without cutting down more trees, and so to preserve forests, correct? So this is really what businesses and investors can try to manage when you think about it. Now, when you think about it, where is the food basket of this world? It's primarily in the global south. So we really need to start thinking about how do we allow the small-scale subsistence farmers in the lower-income countries to transition to more sustainable agricultural practices. So this is where we need to think about, correct? So how can we actually really transition to both address the climate crisis but also the biodiversity crisis? Many of us have focused into climate finance. Many of us have focused on financing climate tech and how to finance the just transition of the hard-to-abate sectors, such as the energy sector. This is clearly important. We are not letting them off the hook. But very often we ignore another player in this world, and that is nature, that provides a natural carbon sink. All right, so let me get back to this slide here. So as I just highlighted, the biodiversity crisis is not only intertwined with the climate crisis, but also with food security, poverty, conflict and forced migration, geopolitical tensions, etc., etc. And lastly, even if you don't care about the climate and biodiversity at all, and you only care about the economy and GDP, we should start thinking and caring about actually the climate and nature, because more than 50% of the world's GDP is dependent on nature and the ecosystem services it provides. Now, you might wonder what kind of services are these really? Well, nature provides, for example, food. It stabilizes the climate, water. The plants are used for medicine. Nature also provides a natural flood defense of real estate, for example, carbon storage, pollination of crops, recreational enjoyment, etc., etc. So these are all services that nature provides. Sadly, nature is a public good, and as we know from Econ 101, public goods tend to be undervalued and underprovided. Okay? Now, what's the way we typically think about it? How to actually fix that issue? Well, typically, we think about intergovernmental measures such as the Convention on Biological Diversity and other global treaties, or governmental measures such as the regulation of the quantity of natural capital, think about establishing protected areas, technology standards, cap and trade systems, or the regulation of the price of this public good, such as providing subsidies to households or to farmers and tax incentives. Okay? We've been talking about these for a long period of time, and clearly these would be first best to help mitigate these grand societal challenges. But we also know that, sadly, they are very hard to implement for different reasons. Some governments are unwilling, unable, ineffective, whatever it is, you fill in the gap here. But while these would be clearly first best to address these challenges, de facto, we haven't gotten to them yet. I think Sweden is probably one of the exceptions here. Okay? So this leads then to the question, well, are we all doomed? Or is there another way how we can potentially try to help mitigate these grand societal challenges? And this leads me to blended finance, be it direct investments or be it through private investing, which could be direct investments, or through blending. I'm going to talk much more about the blended financing structures in the slides to come here. All right. Now, when we move to the financing of the protection of nature, of the mitigation of climate change, of et cetera, typically these have been financed through public funding, such as debt for nature swaps, official development assistance, etc., and philanthropic giving. Yet, as you know, there is a huge financing gap, not only to finance climate mitigation, but also nature, the protection of nature, etc. And so the critical question becomes, how do we close this financing gap to crowd in more private capital? There's tons of private capital out there, tons, but it just doesn't flow in that direction at the moment. And it especially doesn't flow into the global south, where we need the capital the most. Okay? And so this is a relatively recent phenomena where you blend potential the different types of capital together to try to finance nature, to try to finance climate solutions, etc. Let me, for the sake of simplicity here, let me focus on nature for now, and later on I'm going to broaden it up to more generally renewable energy, climate tech, and other types of innovations. Okay, so let's stick to nature. So from a conceptual point of view, it's quite intriguing to think, how on earth do you actually make a financial return by protecting nature? How? And I hope you enjoy my paintings here. Okay, so how do you make a financial return? Isn't that just philanthropy? Well, it's quite intriguing to think about it, especially because typically when we think about nature and natural resources, we think about the transformation of natural resources as opposed to protection of natural resources. Now, while at first it seems challenging to actually get a financial return out of it, it is possible, not always, of course not always, but it is possible by basically bundling a public good with a private good, where the protection of the public good increases the value of the private good. Now, what do I mean by that? Let me make specific examples here. So I'm going to break it down here into the different natural capital asset types. So let's focus on land first, and afterwards I'm going to focus on water. So the main natural capital asset types with respect to land are agriculture, forest, urban parks, natural parks, and genetic resources. Okay, so in terms of agriculture, think about a subsistence farmer that aims to try to move towards more sustainable agricultural practices. Some NGO is going to educate the farmer how to do so. While this service is free for the farmer, somebody needs to pay that farmer, correct? So I'm going to get back to that later on. Now, by engaging in more sustainable agriculture production, let's say moving to shade-grown coffee farming, that helps improve the quality of the coffee bean, that allows the farmer to charge a higher price, especially if that coffee is certified. Okay? So you protect nature, that's a public good, which increases the value of the private good, which in this case is the coffee farming. Or forests. So for example, I lived and worked in Costa Rica for a while. By protecting the nature, the forest, it allows to attract tourism, which helps increase the value of the hotels, of the tour guide services, etc. Again, by protecting the public good, which is here the forest, it increases the value of the private good, which are the hotels, tour guide services, and you name it. Of course, if you have too much ecotourism, that's not good for nature either. Then urban parks and other green infrastructure. Here an example. Some of you might live close to a park, an urban park. By conserving the urban park, it increases the value of the real estate around it. Again, by protecting a public good, it increases the value of the private good that is bundled to it. Okay? And then the last example I'm going to give here with respect to national parks and wildlife protection. Think about South Africa, Tanzania, Kenya, and many other countries. By protecting its wildlife, it again helps attract tourism, ecotourism, that increases the value of the hotels, of the restaurants around it, the tour guide services, etc. Okay? So these are the monetization mechanisms, how by protecting nature, how you can actually get a financial return out of it. What you invest in is the private good, and they basically help protect the public good. Okay? Now, something that is especially important for Sweden, watersheds, coastal ecosystems, fisheries, and oceans. Let me make a couple of examples. For example, coastal ecosystem, by, for example, protecting the mangroves. That's the public good. Well, mangroves are not only a natural habitat for fishes, but it also actually helps protect the real estate behind it from flooding, etc. Okay, so by protecting the mangroves, the public good increases the value of the real estate, which is the private good. And fisheries, by engaging in sustainable fishing practices, you avoid overfishing. So basically, you protect the fishes to some extent, you can argue, which at the same time increases the value of the fisheries because you avoid the collapse of the fishing industry in the long term. Okay? So I hope that helps explain these monetization mechanisms, how you can potentially make a financial return by protecting as opposed to transforming natural resources. Now, before I switch to the perspective of a public funder, let me take the perspective of a private funder. What do private investors care about? It's simple. Don't you love investors? All they care about is risk and returns. Okay? So let's look at what kind of returns are we talking about. Well, there are the direct financial returns, which are generated through these monetization mechanisms that I just explained before. Then you have the indirect financial returns, which includes biodiversity credits and carbon credits. Now, there are several issues related to especially biodiversity credits these days, but clearly these are financial mechanisms that help generate a return. Okay? And then there are the impact returns that investors may gain from investing into nature, climate, or whatever it is. Now, clearly, traditional investors are not going to care at all about these impact returns, but they will care about the financial returns, both the direct and indirect financial returns. And then the impact investors, they will also assign some value to these impact returns. So you can argue that traditional investors are basically just a special kind of impact investor where they assign a value of 0 to the impact returns. So far, so good. Now let's move to the risks, okay? And this is where the blending really plays a critical role. So what the blending does, it basically blends different types of capital, so philanthropic capital as well as potential concessional public funding together to help subsidize and de-risk private capital investments. So essentially they help de-risk and subsidize these investments, which improves the risk-return profile of investment opportunities and therefore potentially become attractive for other investors to come in. Okay? Different private investors come in at different levels. We are not trying to change their preferences here, not at all. But whatever their risk and return preferences are, you might actually be able to meet that through the blending. Okay? So there are different de-risking mechanisms that can put in place. Some of them are at the fund level, some of them are at the project level. At the fund level, you have different levels of seniority, preferred rates of return, financial guarantees. So for example, an IFC or a multilateral development or a government may provide a financial guarantee that helps de-risk these funds. And then at the project level, you also have different mechanisms. For example, concessional funding. So this is funding at below market return. These are not grants, just to be clear. This is not philanthropic giving here. This is funding that is provided, but those investors expect a below market return. Okay? Then ex-ante risk mitigation mechanisms such as design and preparation grants and technical assistance grants. Going back to the example of the coffee farmer, you have a local or global non-profit, basically engaging in capacity building, educating the farmers how to transition to more sustainable agricultural practices. This is basically these technical assistance grants, correct? So somebody needs to pay the NGO. Now, these are ex-ante risk mitigation tools because essentially they help improve the probability of financial success of the project itself. Similarly, design and preparation grants, as any technology, you first do a prototype, test it out, improve it before you scale up the production. Okay, so these are typically funded through design and preparation grants. Then, lastly, we have ex-post risk mitigation tools such as financial guarantees and risk insurance. So this is, in case a disaster happens, let's say in case there's flooding, in case there are wildfires or whatever it is, some crop failure or so, it might be a MDB, Multilateral Development Bank, it might be a government, it might be an insurance company that says, we believe in this project, we do think it's financially viable, but just in case something happens that is outside of your control, we are going to cover the loss, okay? So arguably, all of these mechanisms, they help de-risk these investments, and so therefore, they might actually help attract private investors to come in, okay? And so this is, I know this is way too small for you to see, but these are basically how these funds are typically structured. You have a general partner, and then you have senior LPs and junior LPs. Typically, you would have philanthropies as a junior LP, and ideally, the DFIs, development finance institutions, and multilateral development banks and governments would also take the junior tranche. I'm saying ideally because they often not always do so. Okay, and then as a senior LP, you have the other investors coming in, impact investors, family offices, all the way to sovereign wealth funds and pension funds, okay? All right, so now this is so far to biodiversity finance. Let me broaden this up. Sadly speaking, we face multiple challenges, not just the nature crisis, but also climate crisis, food insecurity, energy challenge, etc., correct? And so, and we face an enormous financing gap. And so the key question really becomes, how do we crowd in more private capital to finance innovative solutions, be it in renewable energy, so just building on what Michael presented at the end, so I'm continuing your presentation here. How do you decrease the price of these technologies that might already exist, but they need scaling up, correct? How do you actually finance these, be it renewable energy, be it nature-based solutions, social inclusion, etc., especially in the global south, where we need the capital the most, and who is the population that is most affected by these crises. So, now, as a public funder, the key question becomes, how do I use my limited, scarce resources efficiently so that I'm not wasting the public's money and I'm achieving as much of a sustainable development impact as possible? As Michael highlighted, this is not a single crisis, it's not just climate change, this is like a total multi-complex challenge, and these challenges are interrelated. So how do you use scarce public funding such that you can mobilize as much private capital as possible to finance these innovative solutions? Many of these solutions exist, but they need scaling up. By the way, you have an interesting example here in Sweden. For example, green steel. You might be familiar with it. So green steel, nowadays it's called Stegra. They actually funded themselves with blended financing structure that allowed them then to scale up the production. Now they are trying to expand globally, or are expanding globally, I should say. So anyway, so as a public funder, again, you don't want to distort markets, and you want to mobilize as much capital as possible in order to increase the effectiveness of your funding. Obviously, this reallocation of risks from public funders to private funders raises important challenges and questions. For example, from the private funders' perspective, there's absolutely no incentive to be honest and to reveal at what risk-return level they would come in, correct? For them, it would always be best to have an absolutely risk-free investment, but that means a public funder would need to subsidize these kind of investments a lot. This clearly cannot be the ideal optimum out there. Okay, so there are many, many open questions. What would be actually the ideal design of such contracts? All you want, for sure, as a public funder is to use your public funding efficiently. And so to do so, there are multiple conditions that need to hold. First, whatever you invest in, it should create a positive externalities, not negative ones. And so there should be basically a non-financial additionality, there should be a positive sustainable development impact, and you should only invest your public funds into projects or into funds where the private market is not yet, so where there is market failure. Otherwise, there's a risk that you crowd out private investments, and you certainly don't serve as a catalyst. Also, you will want to provide as little concessionality as possible. Again, you don't want to over-subsidize the private sector, but just so much that it becomes attractive enough that other investors come in. Okay? So what does this mean? How am I doing on time? Oh, okay. Glad I looked at you here. Okay. All right, so let me show this in a graph. So we have on the y-axis the project's private returns, so this includes the financial and non-financial returns, whatever you value, okay? And then on the x-axis we have the project's societal returns, so basically across society. Oops. All right, then we assume that the DFI, Development Finance Institution, has a hurdle rate above which it wants to invest, and below that it's not interested, okay? And so does the private investor. Basically anything that is above that red line, the private market is going to invest anyway, okay? Because it's attractive enough as a business opportunity, investment opportunity, so the private capital flows. All right, so what does this mean if you want to invest your public funds, scarce public funds, efficiently? Well, you probably want to stay away from areas 1 and 2 because those projects actually have negative externalities net. Don't ask me how you measure that, okay? It's a whole other question, but there are negative externalities overall. Area 3, well, those projects, there you achieve a positive sustainable development impact, but those projects are already attractive enough for private capital investors, so stay out of it because otherwise you might just crowd out private investors. Areas 4 and 5 are not attractive to yourself because they are below your own hurdle rate as a public investor. And so really the set of projects you should be looking at is that blue area here where they have a positive externality, but they are not funded by the private sector. And so this is where you want to consider projects. Now, which projects are you going to invest in? You are not going to be able to invest in all, so which ones are you going to choose? Well, it depends. So if you look at these two projects, for example, you have project 1 that has a higher expected societal return compared to project 2, and it has a lower degree of concessionality that is needed, meaning you as a public funder need to provide less subsidies in order for this project to become commercially sustainable, where then the private capital market comes in, correct? So clearly project 1 is dominating project 2. The case is less clear if you look at this situation where project 2 has a higher societal return compared to project 1, but project 1 is basically cheaper to make it commercially viable. It's not clear, but all else equal, you would expect that you're willing to provide more subsidies and de-risking mechanisms for those projects that have a higher expected societal return. Fair enough? Okay. So now let me speak to two characteristics that are quite characteristics for especially lower income countries. The first one is about increased country risk. So how does this change this whole thing if you face increased country risk? This could be political risk, it could be currency risk, it could be any kind of country level risk. What does this mean? Well, it means that, as you know, private investors don't like risks. They will want to see a higher expected return, so their hurdle rate shifts up. That means the set of relevant projects increases, and so does the degree of concessionality that is needed in order to make these investments viable. So in other words, in countries that face higher country risks, such as currency risks or political risks, funding, let's say, renewable energy projects, nature-based solutions, clean tech is much more expensive and much more difficult in order to actually make them viable at the end of the day. Okay? Similarly things happen when there's increased information asymmetry. So this could be due to, for example, a lack of disclosure. In many countries around the world, not only in lower income countries, there's a lack of disclosure, a mandatory disclosure with respect to non-financial information, which increases information asymmetry. There's also many investors, especially in the global north, might be unfamiliar with the business environment in the global south, which increases the uncertainty of investments. As you know, investors don't like uncertainty, they don't like information asymmetry, so they will want to see a higher expected return, which means the hurdle rate shifts up, the set of relevant projects shifts up, and so does the degree of concessionality that is needed for public investors to put in. So it becomes much more expensive to actually invest in these countries. Okay, let me conclude. Can you tell I'm Swiss, not anyway. No offense, Michael. Okay, so as I mentioned in the beginning, we face multiple challenges. We face an energy crisis, we face climate crisis, biodiversity crisis, and many other crises, sadly speaking. And the key question is, how do we crowd in more private capital to finance innovative solutions, especially in the global south, where we need the capital the most, okay? And so this is where blending comes in. It's certainly not, it's not going to be a solution for everything. It's certainly not the solution. This is not a silver bullet, but it might actually help us get closer to a disaster, okay, to D-Day. Now, while this is a relatively recent phenomena, it hasn't really scaled up yet. And the question is why? Well, there are multiple reasons for it. Multiple reasons. Some of these hurdles include information asymmetry across the different types of investors. Ask yourself, many of you are finance folks. How many of you have been thinking about foundations, family offices, DFIs, MDBs, etc., let alone the partnership between them, correct? So how can we actually better understand the preferences, but also the limitations, restrictions of these different capital providers? How can we develop better metrics and frameworks? And also, obviously, there's a total lack of rigorous studies out there, so we also need to make progress in research. In other words, there's plenty of opportunity for us to have a positive impact here and make progress on all these dimensions. And I'm going to finish with my paintings. Thank you.